Hello there and welcome back. Thanks for joining me for my discussion on accounting for leases, part 5. Prior to watching this video on this section on this student handout for leases, please read pages 878 to 880 in your textbook and complete the Learn Smart for this section. Things are indeed going to be a little complicated, and your understanding will be greatly enhanced if this isn't a first view for you. Our topic today is going to be on residual values. First of all, let's review what that is. A residual value, simply stated, is a commercial worth or fair value, the value of the property at the end of the lease. So you are not going to keep the property, you are going to return it, if you're the lessee, to the lessor. Now, if the lessee has guaranteed the residual value, that means that they're guaranteeing how much the property will be worth as a minimum when it's returned at the end of the lease. Quite simply, this takes away some of the risk for the lessor in that it helps to ensure that the lessee will properly maintain it. Because the lessee is guaranteeing the amount that it will be worth at the end, the present value of the guaranteed lease payments is included in the calculation of the minimum lease payments, which means it's included in the capitalized cost of the asset. And the result of the lessee guaranteeing it will be worth the same amount, or the guaranteed residual value amount at the end of the lease, makes the lessee and the lessor have the same amortization schedules. Now let's compare that, the guaranteed residual value, to an unguaranteed residual value. So we're saying when the lessee returns the property at the end of the lease, they do not guarantee how much it will be worth. Because of that, it's not included in the calculation of the minimum lease payments, and the lessor does include the amount of the guarantee in the amortization schedule, but the lessee does not. So in the case of an unguaranteed residual value, this will be the first time that we haven't had symmetry in accounting, and there'll be different amortization schedules for the lessee and the lessor. So to summarize, different amortization schedules for lessee and lessor with unguaranteed residual values, the same ones with just a plain guarantee. Let's look at the accounting. Let's go back to our initial question that we've been playing with through this whole handout. How would a guaranteed residual value change our example? Let's assume the same facts we always start with. $15,000 piece of equipment, 10%, and 3-year lease with payments due at the beginning. But now let's add the assumption that the equipment will be returned at the end of the lease, which says, yes, we're returning the equipment. We don't own it at the end of the lease. And that we're guaranteeing the residual value will be worth $1,000. The calculation of payments is altered in a manner similar to what we did for a bargain purchase option example. So the lessee is guaranteeing that the asset will be worth $1,000 at the end, so this amount needs to be the ending balance in the amortization schedule. So we start with the amount of the equipment. We subtract the amount that will be recovered by returning the equipment in its present value, or the present value of $1,000, using this interest factor from table 2. Subtract it out, the present value of $1,000, and this is the amount that needs to be recovered through payment, and this is the amount that will be recovered through returning of the equipment. You use the new amount, the amount of the equipment less the guaranteed residual value in the numerator, divide it by the present value for annuity due interest factor from Table 6, and you come up with $5,209. Go ahead and put this on pause, and using the charts and your calculator on a set to an annuity due calculation, and see if you can calculate the amount of the payment. Oh, good. Welcome back. Now that you've assured yourself that you can calculate the amount of the payment, let's see if you can make an amortization schedule. Remember, both the lessee and the lessor will have the same schedule and a guaranteed residual value. It will start with $15,000, and at the end of the period, it needs to end up with $1,000 as a balance in the amortization schedule, reflecting the fact that $1,000 in equipment or cash must be paid by the lessee to the lessor at the end of the lease. Go ahead, put this on pause, and fill out the amortization schedule and see if you start with $15,000 and make payments of $5,209 and accrue interest for the last year. Don't forget to accrue interest for the last year. And let's see how your amortization schedule comes out. Put this on pause and we'll see you in a second. Welcome. How'd you do? Let's briefly take a look at our amortization schedule. Payments made on the first day, it's $5,209. We had no interest on the first payment since it was paid on the first day. We did on the second and the third. We accrued interest at the end, and now we are responsible for returning equipment worth $1,000 or to make up the difference. If you put this on a chart, it's easy to see, I think, or at least it helps see what's happening. We have a 3-year lease. Payments are made at the beginning of the lease, $5,209 for the first year, $5,209 for the second year, $5,209 for the third year. Payments are made at the beginning. At the end of the third year, you owe either $1,000 or equipment worth $1,000, and so you do accrue interest for this time period, which is what happened right here. You had no interest payment. I think we need to get that to 0, don't we? So you have a $908 balance. You accrue interest in 92. You add that to the 908, and it shows you owe $1,000. How'd you do on your amortization schedule? Now, let's look at the journal entries to record the inception of this lease. I'd like to look at the journal entries to record the inception of this lease for the lessee and the lessor. And for the lessor, we'll assume that it's a direct financing type of lease. They're just carrying the paper on it or carrying the loan. In our first example, in the second loan, we'll assume it's a sales type lease. They're actually selling the equipment. So let's start then with the lessee, our first example. The lessee receives equipment worth $15,000, records the payment of $5,209 made on the first day, and sets up a lease liability for the difference. I'm not going to show any of the payments because you already know how to record payments on liabilities, but I am going to show depreciation because the calculation of it is slightly different. The lessee records depreciation each year, but it changes the amount of depreciation because we have a $15,000 piece of equipment with a $1,000 salvage value now. That's how much it's going to be worth when we get out of this lease. So we're not going to consume the benefit of that $1,000. We're giving it back. So we'll take $14,000 and divide it by 3. And that's how, under a guaranteed residual value, you calculate your depreciation expense if you are the lessee. Let's move to the lessor now. Remember, the lessor no longer owns the equipment. They have transferred title to the lessee, at least for the time being. They receive the first payment on the first day, and they set up the lease receivable. And notice it's the same as the lessees. There's symmetry between the two. And they remove the inventory from the books. Remember, they went out, purchased the equipment, and turned around and leased it directly to you. A little different for a sales type of lease because it's considered a sale. So first we record the sale of $15,000. We record the cost of goods sold of $12,000, and we take out the inventory. I'm now noticing I'm missing my lease receivable, so my journal entry doesn't balance. That's kind of cute. Lease receivable needs to be in there to make the entry balance, and even though we're doing leases and it's a little hard, our debits and our credits still need to balance. So I'll insert the 9791. There's a lease receivable in either case of 9791 for both the lessee as a payable and the lessor as a receivable. The receivable and the cash equal our sales price, so 5209 and 9791 equal the 15,000, and then we pick up the inventory and cost of goods sold normally as we would for any type of sale. These then are the journal entries that show you how to record the inception of a lease for the lessee and the lessor when the residual value is guaranteed. I did not fool around with showing payments because I don't want to make this video unnecessarily long, and payments are recorded normally. Now let's return to the lease example and say, what are the entries when the equipment's returned at the end of the lease? So you're at the end of the lease. If you're lessee, your amortization schedule shows you owe $1,000, and in our first example, let's assume that the equipment's worth at least $1,000. You can take the leased equipment off of your books, take off accumulated depreciation for the 3 years, and it will equal the $14,000, 4667 times 3, and you use that to satisfy your lease liability. And you're done. You return the equipment and the lease is over. What would it look like if the equipment were worth $1,000 or more, but was worth something less, like $500? You still need to get the lease liability off your books. You still need to get rid of the accumulated depreciation in the leased equipment. But now you have to make up the difference because you guaranteed it would be worth $1,000. So you give them cash and record a loss on the transaction. And that is the accounting from the lessee's perspective. What happens from the lessor's perspective? Well, if they return the equipment to you, you pick it up at its used value. Let's assume that's $1,000. You pick up the equipment and you remove the lease receivable from your books. They used returning of the equipment that was worth at least $1,000 to pay off their liability. But what now if the equipment was worth $500? They would need to give you cash, and you would record the used inventory at the lesser amount, the $500, and set up the lease or remove the lease receivable for the $1,000 that's still on your amortization schedule. Notice in all of these entries that we looked at, a lease liability was coming off the books for $1,000, a lease liability or receivable. For the lessee, you paid it by returning the equipment or by returning the equipment and some cash, getting rid of the liability. And if you were the lessor, it was paid to you in the form of equipment worth at least $1,000 or cash and equipment worth $1,000. That is the entries for when the equipment is returned at the end of the lease. Returning to the amortization schedule, let me point out to you that the balance on it at the end of the lease is $1,000, and it needs to be paid by the lessee to the lessor, either by giving them equipment worth at least $1,000 or equipment that's worth something less and the cash difference. That includes my example of a guaranteed residual value. Let's move on to an unguaranteed residual value. Thanks for joining me.